Hey there, welcome back to my channel Accounts Accuracy, and let's see what happens after calculation of net profit before tax while calculating cash from operating activity. If you have not seen my previous videos, do watch them to understand this video of cash flow statement well. Now see here, after calculation of this net profit in the working note, we start with the steps of calculating cash flow statement from operating activities. And for that, few adjustments are needed to be done, that is for non-cash items and for non-operating items. So what we do basically, we add all the items which are non-cash items, just like depreciation. Now think of these furnitures. Do you think these furnitures, when they were purchased, they remain same throughout the year? No, they depreciate. Now if they depreciate, do we pay cash for such depreciations? Even though its value decreases, but never cash flows out of the firm. And while calculating the net profit, we deduct such depreciation for which no cash flows out of the firm. Hence, that must be added because that hasn't reduced the cash in company. In the same way, when goodwill of the company, when it goes high or when it goes down, never cash moves out of the firm. So that's why if there is any amortization, that is reduction in the value of goodwill, patent or trademarks, no cash flows out of the firm. So hence that must be added. Because for these items, no cash in actual sense has gone out of the firm. Just like loss on sale of fixed assets. Such fixed assets which are already used by the company and those assets are sold by the company. On such assets, no cash in actual sense goes out of the firm. Hence, that must be added. So, items like interest on borrowings of debentures, interest on bank overdraft, cash credit, writing off discount on issue of debentures, writing off underwriting commission, share issue expenses, and writing off premium on redemption of preference shares or debentures. These all items we show either in investing activities or financing activity. Hence, these are needed to be added over here because when we calculate net profit, we already deducted these amounts and these amounts had reduced our profit. So that's why it's needed to be added over here because again we are going to treat it either investing or financing activity. The vice versa happens for items for which we write in the books of accounts but in real sense we don't get the cash. Few items like income and gains are deducted from non-profit before tax because these are shown either under investing activities or financing activities. In real sense, gain on sale of fixed assets come in the firm just for such purposes, decrease in provision for doubtful debt. So no inflow happens for such reasons and few items are there which like interest income, dividend income, such items are the part of financing activities. Hence, that must be deducted over here. Now, once we just add it, no flow of cash in actual sense happens, we get the operating profit before working capital changes. So for this, there is a sum which I would like to discuss with you. Here is a sum for which you are supposed to find out operating profit before working capital changes. You are provided with all these items. Now you have to simply add all the expenses for which no cash flows out of the firm and you have to deduct all the incomes for which no cash has come in the firm. So here you can see this is the format where I have just simply put the amounts which are given in the sum. Just like net profit before tax, it was given over here, net profit before tax. Depreciation we need to add as no cash has gone out of the firm. So that 1,40,000 depreciation value on fixed assets is added back to the net profit. Again, goodwill amortized. It must be added because no amount has gone out of the firm. So 30,000 for goodwill amortization needs to be added. Again, we have the interest on debenture, that is 28,000 needs to be added because again it is the amount which is the part of financing activities. Debenture. Interest on debenture is not the operating activities. So hence it should be treated in the financing activity. Hence it must be added back. Writing off underwriting commission, that is writing off expenses on share issue, that is 1000, that must be added back because again it's a part of financing activity. Then we have loss on sale of machinery. As I told you, no cash has gone out for this, hence it must be added back. So loss on sale of machinery, that is 30,000, should be added. Now last two items are the interest items, just like interest and dividend received on investment. So this is the amount which needs to be shown as an inflow in investing activity. Hence it must be deducted over here because as it's been added in the profit, but it needs to be shown in the investing activity, not in operating activity. This is the item of investing activity, hence it must be deducted over here. Gain on sale of investment, this is again the part of investing activity. So these two items, as these are the items of investing activity, it needs to be deducted from profit over here and added in the investing activity. Because you can see here investment word is also attached, so it is clearly understood that these two are the items of investing activity. So after deducting these two amounts, 46,000 and 20,000, we get the operating profit before working capital changes, and this is your answer. So once we add back all the non-cash expenses and non-operating items and deducting items like which is not the part of operating activity as well as which are non-income items, and after deducting the items which are not the part of operating activities, we get operating profit before working capital changes. I hope you might have understood it. Please don't forget to subscribe my channel and hit the big fat like button because it motivates me to make some more videos for you. Thanks for watching.